Thanks so much for joining us here on a very busy Monday. I'm Marlon Bowling with you, your tour guide to the ag commodities. Let's take another look and see if the grain markets have changed their trajectory from the opening bell here today. Let's go to the corn board and see what's going on. Our quotes are from bar chart. So on the corn, we have the December contract right now unchanged at $4.77 1/4. March unchanged at $4.92 1/4. Doesn't get any quieter than that. Literally, it doesn't. In soybeans, you now have November 9 1/4 lower at $12.87. January down 8 3/4 now at $13.04 3/4. That's about a dime off of our overnight high there. Starting to be a bit of a concern here on the soybeans. Now on wheat in Chicago, December is starting to firm up. We're now 5 3/4 higher at $5.85 1/4. That's off of its earlier low by about 12 cents now. In Kansas City wheat, you have the hard red winter wheat on December up a penny at $7.12 1/4. That one's kind of dragging its feet, but it's in the upper half of the trading range. Minneapolis wheat on December, we're now a penny lower at $7.69 1/2. It's been on both sides of unchanged overnight and this morning. In the cotton trade, you have December now 45 points higher. We're at 86.36 after a high of 86.73 earlier in the overnight trade. We have the one and only Mr. Chris Swift with us. He is with Swift Trading, and he is based in Nashville. How are you doing?
Fantastic.
Happy Monday. Good to have you back.
Same to you. Good to be back.
All right, so the markets are kind of quiet. That'll give us a little time to kind of assess the situation overall. What's going to be impacting the grain markets here as we get through harvest, and how long do you think that pressure will last?
Well, it could last a pretty good ways because we're dealing with a couple of different situations. One, we have a really quick increase to the harvest right now. That's probably the biggest thing more than anything. And then the next thing is going to be the Mississippi River barge. So with the river low like that, it keeps the transportation of the market, keeps transportation of the goods moving up and down the river. And so it kind of all congests and sit there for a while. So that with the harvest and looking like a really good corn crop so far, it's going to be tough to rally it, I think.
Did you see the overnight sale?
I did.
Export sale?
Yeah.
What I'm talking about is Mexico came in over the weekend and bought 1.66 million tons of U.S. corn, even though they claim they don't like our corn, but they bought that much anyway. And this is on top of some of the corn that they bought like a week ago. So, Chris, you see that. And then if you look at where we're currently trading the corn, you juxtapose this against that, and it's unchanged, Chris. That's not very impressive.
No, it's really not. And if you look at the chart, we had some extreme volatility over the summer. Big price swings, 35, 40, 50-cent swings at a time. And now we've kind of consolidated down here. We've gotten to the lower end of the range, just up under $5 a bushel, and that's where we've been sitting. So what the market is actually waiting for is probably more information from the export, as we get more exports. And then as the harvest comes along, everybody's going to be anxious to see if USDA changes anything on the acres number from that big 4 million acre increase or anything on the yield. And yield probably a little bit less likely to see much change on it. Beans, probably a lot of change still. Second crop beans are really needing some rain right now. The initial bean crop that came out, we've already heard some bad things happening to it. So it's going to be a little bit of a varied situation this year, all the way into next year with a big corn crop and a smaller bean crop.
It seems to me that local storage wasn't much of a problem this year. Elevators were pretty empty, I would assume, going into harvest here. So if that's the case, does that mean the basis would rebound faster this year than it normally would during harvest? What do you think?
It's possible. A lot of that will just hinge on the demand tonight. If we've got a lot of demand, then it could shore up the basis quite a bit. But unfortunately, we do have more on-farm storage now, and so that base is probably not going to be as big as what it was last year, where we had local areas that had really low amounts of carry-out. Then they just were nothing, and we had to start railing in or trucking in corn from various different places. This year, we'll probably have enough to go around, especially start to get a little moisture in to raise the river levels.
October options expired Friday on the grain. With the quietness of the market right now, options are probably becoming more affordable, aren't they?
They are. We've seen the volatility premiums come down in them, and they're not outrageous. The problem with buying puts on grain, and especially in the corn market, is you don't have a lot of price there. So by the time you want to pay something for a premium and then look at the out to what the carry charge is, there's just not a lot out there. So I would be a little more cautious about wanting to hedge corn with put option stuff. The real thing maybe is just to go ahead and market it and put that cash on deposit where you have at least some other place to put it than just having it stored.
I guess I was looking at it more from the re-ownership side,
right.
on the call side, maybe.
Right. And again, now you're dealing with premiums. Not only do I have a carry charge out there in the market, so I have to pay that if I'm going to re-own it, and then I have to pay the call option premium to re-own it there. So it might be better, again, just to have that cash in your pocket and put it on deposit for a little while.
Okay, we'll come back in a moment. We'll take a look at livestock next. All right, we're back talking with Chris Swift of Swift Trading. Want to take a look at livestock trade?
Absolutely.
Okay, let's go ahead and do that. Let's bring up the live cattle board. And we are currently still lower, but we are coming off of those earlier lows after the start. You have the October live cattle only 30 lower now at 186.75. December down 35 at 191, but it's off of its earlier low by 45 cents, Chris, so it is working its way back. And on feeders, you have October down $1.35. We're at 257.80. But it looks like that one has clawed its way back about $1.15 already. November down 120 at 262.32. So hold those numbers in your head for a little bit. In lean hogs, we are mainly higher. Now, October is down a dime, but December up 37 at 72.55. And the biggest gain would be February, which is 72 higher now at 76.07. That's within about 35 cents of its high of the day right now. So let's go back to Chris and talk about this. Okay, we have the cattle on feed report that came out last Friday. Didn't seem to surprise anybody.
11 million head on feed. We only dipped below 11 million head either 1 month or 2 months in the last 18 months. So very, very steady being able to keep that number of cattle on feed.
Any signs of rebuilding?
Oh, no,
successfully?
None. The heifer slaughter is still elevated. The cow slaughter is still elevated. They're both coming down, but we've not turned the corner where you could say now we are slaughtering fewer heifers and growing more heifers. That's just not the case just yet.
Interesting stuff. All right. Now, from your perception, consumer demand, can we hang in there at this level?
It has been the most perplexing of anything. I've heard other analysts on here talk about the resilience that the consumer has had to the higher prices, and we all know that impacts it, but for some reason, it just hasn't yet. I'm not saying that it will, but it hasn't to the point, and maybe it's a combination of both. Maybe we have seen some reduction in consumer demand, but we have such lower cattle and beef quantities out there that is making up the difference. So it's going to be a long road to hoe, I can tell you that, to get the beef industry either stabilized right now and then either being able to grow a little bit and again, to keep it to the level to the consumer where we don't lose that beef demand.
It's hard to wrap your hands around that drought will probably end up having an impact on the U.S. economy for 7 or 8 years total.
Years total, absolutely.
Yeah. All right, thanks for coming in.
Always a pleasure, Marlon. Yes, sir.
Chris Swift of Swift Trading with us. Tammy, back to you.